Yo, welcome back to a video. We're going to be doing something new today, and it's going to be different sort of series than the date series, right? It's going to be more about learning ICT itself. I'm in the Tactical Traders in Justin Werline's mentorship, basically. There's this person called Christopher who is really good with ICT's concepts. He's really accurate with his trades, stuff like that. I'm just been inspired to watch these videos, and obviously I'm not going to be straight away as good as him, but I'll be learning towards it, right? So this is my interpretation of ICT's videos. Listen at your own risk, obviously. I'm not professional or profitable. Yeah, and there's going to be reinforcing liquidity concepts and price delivery. That's from the ICT'S channel. I'll put the link down in the description so you guys can watch that in your own time. Let's just get started. So we're going to be going over what is liquidity. Liquidity is just resting orders, buy stops or sell stops in the market. So that will be above resistance or above support. So we're going to also be going over internal versus external liquidity, and also why context matters. So what's external on a daily chart might be internal on a weekly chart. So what that means is a weekly fair value gap might be an internal draw, an internal range liquidity on the weekly, but it would be also a external range draw on the daily chart. So that's basically what it is. And understanding a high time frame draw, so say we're rebalancing into a weekly fair value gap, that's your high time frame draw. So on the low time frame, say on the daily, be anticipating that weekly fair value gap, and that will be a target for you, right? That's your draw on liquidity. So going over external range liquidity. So what is external range liquidity? It's liquidity that sits outside the current trading range. It can be buy side or sell side, and as long as it's just the range high or the range low, it's just external range liquidity. And what do? So they act as liquidity pools. So let's use the example here. This is from ICT's video. So I'm not going to be using my own examples because probably won't know what I'm talking about, you know. So I'm just using strictly ICT's examples, kind of quoting him, but just condensing it in this video. Right here is your range high. Right here is your range low. That is external range liquidity. Over here is your internal range liquidity, this for value gap, and we'll be going over internal range liquidity later. This external range high, external range low. And why would they act as a cluster of orders? Because over here, people who got lucky, people who shorted this top bit and got lucky, kept going lower, kept going lower, kept going lower, kept going lower. Say they still want more, want to see 60 or something on the Japanese to dollar amount. They want to see $60 or 60 amount of 60, right? They want to see price go to 60. Then they'll keep holding, they'll keep holding, they'll keep holding, and the price is just pushing. And this is where the orders are, right? Their buy stops or their stop losses. Over here, since you're selling, since you're shorting over here, these are your sell stops. Institutions will take those orders, so your stop losses, and they'll use it to push price down, right? Because obviously there are orders up here. They're using your orders that you're giving to them to push back down price, so to sell those orders to somebody else. And which is why you'll see at the top over here, price will just go down, go lower, right? Obviously narrative matters, context matters, so it won't always happen, but when it fits, it will happen, right? What else? And another reason why there's clusters of orders up here, because people will think that up here is resistance, so they'll short over here, put the stop losses, and again, institutions will use those orders to come and push price back down. That's basically what they do. The market seeks to pair those orders, so institutions use these orders to pair the liquidity up here and push price back down. External range liquidity can be low resistance liquidity in essence and high resistance liquidity in essence. And Low resistance liquidity, it's just as the name sounds, it's easy for price to run through, but high resistance liquidity, it's harder for price to trade through. So we'll go to internal range liquidity now. So the definition of internal range liquidity is literally, as it sounds, liquidity that exists inside the current trading range. And these liquidity areas are just inefficiencies, so fair value gaps, liquidity voids, order blocks. They're just liquidity, right? It's not anything that special, but you'll learn it to be these. Swing highs, swing lows, stuff like that. They can be internal or external. It depends on the context you're in, but overall, they can be both, right? So price trades within the range to rebalance these inefficiencies. So those internal liquidity. So why is it important? Internal liquidity provides setups inside ranges. So going back over here, actually we'll just keep going. Internal liquidity provides setups inside ranges. So say over here, your a market maker model here. This is from Justin Merline's video. This is your range low, range high, and your low risk buy is in this fair value gap, right? So he's going from internal range, so which is your fair value gap inside this range, into external range. So this is your new external range liquidity. Now you could use this to get these highs up here, and that's perfectly fine. That's in fact what ICT did more to the end of the video. So we'll go on to my notes, obviously, just explain that later. And internal liquidity often becomes fuel for runs towards external liquidity. So as I said over here in the market maker buy model, your range low, range high, your external ranges, your internal range liquidity, your fair value gap goes and becomes fuel to push higher to this external draw. So that's basically it. So examples of external and internal. We're going to be using ICT's external and internal examples. What ICT talks about here, I'm just going to go through it really quickly, is this external range low. Over here is your external range high. As soon as we come back over here, take out the external range high, this becomes our new external range high, right? Pretty simple. So there's swing lows here, here, relatively equal lows here, your fair value gap here, and your external range liquidity here. So what he talks about is after we've taken out such external draw, your external draw, we could expect price to rebalance, right, into these fair value gaps down here, this whole imbalance, or we could come back into these relatively equal lows, which is also conveniently around equilibrium. So that's probably the target that you will have. Obviously you will need to wait and confirm that price does do what it does, so it does go lower. So confirm that price wants to go lower first before you take anything. So he also explains that this right here, your fair value gap right here, why does he choose this fair value gap and not this one? So we have buy orders down here, right? Just only buy orders up here. And then after this candle closes, we get this candle and price comes back down over here. So this area is balanced, right? In essence, there's both buy orders and sell orders, therefore it is balanced. So only this part of the fair value gap is not balanced, and it's much less significant than this fair value gap here. Why? Because using these lows, you can use this as your external range liquidity, which in your grander scheme of things is your internal range. So from using this range low, using this external range low to this external range high, this is your internal range liquidity. And in the same way, you could use this external range low, using this low here as your external range instead of this low, to this external range high. That can be that can also be external. That's why this gap doesn't show any significance. That's why price doesn't hesitate to go through this gap and just pushes through and takes out these relatively equal lows, which is also at discount. Now we have this fair value gap right here, and you can see with these two candles, we actually reject off of that, off of this area here. That's kind of like proof of what and why that happened and why this fair value gap is significant. So once we take out this external range low or internal range low, this becomes your external range high, right? And also this now becomes your new external range low. So as you can see, we also have this fair value gap right here, and we've also created this order block, which is your internal range liquidity. So you could use this internal range liquidity to frame the trade and go lower into here, into the swing low over here, and go for these lows down here. But obviously you want to see the higher time frame and make sure that the narrative is lower. So that's actually kind of it. We're going to now go to the notion and explain. So ICT uses this image. He uses this external range low, that's why he's put the line here, and this external range high, that's why he moved the high from this high to this high. So he uses this. We tap into that order block here, and we could come lower, but if we don't, say we don't, and we actually run through this high of the order block, our next draw on liquidity will be this fair value gap, because there's only sell orders gone through here. So there's an imbalance there, there's an inefficiency there. This becomes our internal liquidity. So external draw, and also this is an internal draw, but it's less significant because it's in discount in the bearish range. So we want to show off premiums. So this same fair value gap, this is your monthly fair value gap. We've gone straight through that monthly order block. This is the monthly, by the way. We've gone straight through that monthly order block. This is the same line, straight through it. And now we can expect that monthly fair value gap to be our draw on liquidity. This is our internal liquidity. So he also says on the monthly, this might be our internal draw, right? But on the daily or on the weekly, this is also external liquidity, right? We're just going through external liquidity. And because we've ran through that order block, we can expect this to be a low resistance liquidity run, because our high time frame draw, our monthly draw, is that fair value gap. So then ICT drops down onto the daily. He emphasizes these highs up, down here or up here, and we can see that it's low resistance liquidity by how price runs through these highs, these swing highs. So once we understand the higher time frame, that's what he says, which and where it's trying to trade to, you'll be able to create low resistance liquidity runs from understanding that higher time frame narrative, from understanding that we want to go higher. And then he drops down to the 4 hour, and he says something about institutional order flow here. I'm not sure what he's talking about there, so if you guys can or know what he's talking about there, you can probably let me know. He says something here about switching order flow to be bullish at this area. I'm not really sure. I'm gonna ignore that bit. I'm not gonna take any notes off that because I'm not sure what he's talking about. He uses a higher time frame institutional order flow to frame out where internal and external range liquidity is and what kind of entry he's using and how it aligns with the higher time frame. So this is your external draw, or external range, and then here discount for value gap. But notice sell orders have been in here or here. So we come higher, come lower, take out this low, swing low, go into this fair value gap, we trade higher, trade into this fair value gap here, reject off of that, come lower into this fair value gap, and then we reject again. Higher time frame draw is higher. We can expect after taking out an external draw to reject off of that, since higher time frame is lower. So obviously, as you can see here, we didn't actually take out that, but we did take out here, right? So this is your external high, external low, we took out external low, and then we make an order block. Over here, we trade inside that, and we could now expect us to go higher. And again, in the same way here, pick out sell side or internal draw, come higher, order block. You could expect it to come even higher, and then external range low, external range high, internal range liquidity, inside, boom, your external draw here. You could expect these highs, but I probably would have got stopped out. Yeah, he doesn't really show that bit. Yeah, he scales down to the 15-minute time frame over here, and we see also the same thing. Your external range low, external range high. This could also be your external range high, but that's kind of it's kind of, I don't know how to explain it. It's kind of like a bearish sort of range, so you don't really use it like that. You want to use it like this: external range low, external range high. Go into liquidity, sell side liquidity. You get an order block here, and then we tap into the order block again, and we come higher. We also use this order block here and trade higher off of that. And since this is internal range liquidity, the order block is internal range liquidity, we can expect to see external buy side liquidity off of this order block. So if you are buying up here, you can see this buy side up here. So we run through that. So this is the same example, which is down here. So this is your external range low, high, external range low, and we have low resistance highs up here because the higher time frame drill is higher, right? Our SIBI has not been tapped into yet. It's not balanced yet. So we want to come higher and balance that out, and then return back to whatever draw we're going to after that. But we don't really care about that yet. These highs are now low resistance because the high time frame draw is higher. So then we use this order block right here, and we trade back into it. We actually disrespect the block here. I'm not really sure why ICT still uses it, but they didn't explain it, so I'm just gonna say it anyway. Yeah, so his order block here, trades into it, collects orders. This is your external range liquidity, into internal range liquidity, trades higher, another order block here, or proportional block here, and then we come higher. But yeah, proportion blocks that we haven't really covered yet. I've just learned it by myself before, so just remember it then. But I will go over it in the next videos in the series. This is some soft source, right? So if there's consolidation here, we should use the swing low after the consolidation move. So consolidation, swing low, we can use that to the swing high, or to the range high. This is kind of subjective as well, because this is also consolidation. You could also use this swing low instead, and you can, but it's not that much difference. This is the most prominent one. You could use this one, but it's not that much difference. ICT goes to the 1 hour chart. He says, if we know that the market wants to trade higher, and we also know that a retracement should take place and the market is trading lower, then we should look for what sell stops are the market trading to. If this is the case and we are going lower, then we should think to look for external range liquidity on that time frame we are using. So go up here. This is your external range liquidity. We take out external again, come lower, and then this is your sell side liquidity. This is also your sell side liquidity, but I didn't take it out. So come lower. This is your new external range liquidity, right? And then we come higher, your other external range liquidity. All of these swing lows could be external range liquidity, right? And at the same time, it could also be internal range liquidity. So here is internal range liquidity. We sweep that, external range. So we come to this order block, right? Tap in, external. So this is your new external range liquidity. We've taken out external range liquidity, come lower, resweep, create an order block, we have willingness to come higher, so we start coming higher. And this is also your market maker sell to buy model. This is your sell side liquidity. We have our order block here. This could be a entry here. You have your fair value gap, and again your internal range liquidity here, taken out, order block. This is your new internal, this is your external, boom, order block, and we come higher. High time frame narrative is higher into the CB. So the sell side marked are all external sell side. If it has breached the lows and market higher time frame narrative is bullish, then we shouldn't meander and hang around at those lows, but have willingness to go away from it. If this happens, the market is showing you and tipping its hand that it's time to go higher. So hope you guys have enjoyed that video. Hope you guys have had some value from this video. Obviously this is still my own interpretation of that video, so if you want, I'll put the link down below. So if you guys enjoyed this video, like, comment, subscribe. I love and appreciate all you guys. Peace.